Boom, boom. How's it going? How's it going? It is I again, your boy, TJ, Taurai Jack, and we are talking about property. We always talking about property anyway, but as you know, we always bring in the experts to tell us or give us advice or to give us guidance or to tell us what we need to know so that we can be clever like them. Well, you can see here my background is pretty clean, and some other people's backgrounds is full of knowledge. So let's hear what the knowledge is all about. Thomas Villian is someone else that I've been hanging out with. He's been doing trusts for us. And without wasting time, Thomas Villian, how are you?
I am exceedingly well, and thank you so much for the privilege to come and share my passion with you. And I hope to give you some insights into the use of trust in financial planning, especially property investment as well. So yeah, I'm really looking forward to the event. Thanks.
Awesome stuff. I have had the privilege of utilizing your services and in our business and things like that. And our relationship goes not just having these conversations here, but actually knowing the services that you give and the expertise that comes with it as well. But tell us a little bit of your background. Who is Thomas?
Okay, great. Yeah, I think the first thing to mention is that I am an entrepreneur with some very good qualifications. So I come from a legal background, so I've got 2 law degrees, and I've also got a degree in theology. But most importantly, I've got 23 years of experience in trust law. And as I mentioned to you previously, I was also involved in being the CEO of a property company and the CEO of a retail development company. And that's the reason why I got involved with that, is that when you look at wealth, you cannot look at it in isolation. It's a multi-million rand business. So if there is skills that you need in this business, then you need to go get them. And that's what, so that's my prime love is basically fiduciary law. And I've been doing that for 23 years. But I needed to find out how the property industry works. What are the nuts and bolts? What is a good investment opportunity and what is not? So I had the privilege of being the CEO of a property company and also a retail development company. But yeah, my first love is basically trust law. I've also lectured at the University of Pretoria in trust law. Professor Anton van der Linden is a very good friend of mine. And interestingly enough, the University of Pretoria is the only university in the country that presents courses in trust law. So with all universities with law students and with chartered accountants, they never had formal training in terms of how to use a trust in financial planning. So that's why I firmly believe that we've not utilized the actual true potential of the legal structures. Now, let me tell you how I ended up in this environment. I started my legal or law career at the Master of the High Court in Cape Town. Now, as many of you would know, at the end of your life, that is where your estate ends up, is at the Master of the High Court. Then your estate gets administered. And every day we did deceased estates, and then you would issue an estate duty assessment of hundreds of thousands of rands. And another part of the day, we would register trusts. And it really baffled me how it is that people pay estate duty, because it's a completely voluntary tax. And the funny thing is, it's normally wealthy people that end up paying estate duty, but yet they were ignorant. That's the penalty you pay for ignorance. So, and it didn't sit well with me. So I started developing a proactive estate planning strategy just for the fun of it. And the idea about proactive estate planning is that when you start accumulating wealth, you do it in the right structure. You have to have the broader picture in mind. Because as a result of my strategy, one of my colleagues sold my plan to Old Mutual Trust. And when they started the Intervivos Trust division of Old Mutual, they invited me to come interview for the position. And I was the only person to be interviewed. So, and it was a very interesting journey because we had to sell the concept of proactive estate planning. Because in the traditional estate planning environment, somebody would accumulate estate worth, say, 10 million rand, and then they would go to an estate planner and say, look, I've got a problem. It's too late. you've wasted the good years of your life. So that's why I firmly believe in proactive estate planning, and especially when you use property as an asset class in financial planning, then you are going to be wealthy. The involving property in your wealth creation would definitely cause you to have a sizable estate. So what I'm going to present to you now is the lecture that I present at the University of Pretoria, just to introduce people to the concept, because nobody's had training in trust. People think it's a very foreign concept and it's only for very clever people or whatever the case might be. But what I want to tell you is that it's such a simple business once you get used to the concept. So it's very easy to incorporate in your financial plan. So the title of my presentation is to trust or not to trust. That is the question. So not every person out there is an ideal client for the trust environment, because you must realize that when you look at wealth creation, it is a business. So if people just want to dabble in property and dabble a bit in this or dabble a bit in that, then you're probably not the right client for a trust. But if you are serious about your wealth creation, then a trust is something, or legal structures per se, is something that you might have to start thinking at in terms of your financial planning. So as I mentioned to you, the slides will be available on a link afterwards. And please feel free to ask me any questions if you have any. So let's just look at.
So before you jump onto your slides,
yes.
I have a confession to make, right? The first time I saw your profile coming through to my desk, and you're being recommended for A, B, C, D, and I looked at it and I saw a whole lot of qualifications, and I said to Elise, I don't think this guy is really cut out for us, because he's an academic. And Elise says, why do you say that? I said, he just goes to school. That's all he does. So I don't want to hang out with people that go to school without doing. And she says to me, no. You didn't look at the profile fully. So let's jump into it. So we started looking, and what I love about you, Thomas, is that not only are you an academic. So for me, I don't like academics. People that read books and then they regurgitate, because all they're doing is telling me someone else what they've read.
Yes.
What I really like about you is the fact that you're a true academic. You are always chasing for information. That's being wise. That's number one. Number two, you practice what you're talking about. And for me, people that practice and teach others, for me, they are real teachers, because they are teaching you from the core of what they know and what could go right and wrong, because they have done it. So I'm excited of the presentation that you're going to show with us. You can go.
Absolutely. The thing is, people say that it must have been difficult working at the Master of the High Court, because you work miserable hours and your pay is so little. But I promise you, the time you spend there is just practice, getting exposure, practical things every single day. So I think from that point of view, it was really a privilege working there and getting exposure to all the practical side to wealth. And also being the CEO of a company was also quite informative. And I can just mention that I had a client base internationally, clients in the UK, in Sweden, New Zealand, and Australia. So and I'm still young, so my learning is not over yet. I'm actually endeavoring in studying international trust in Malta. So I hope to go there in March, and most likely longer in June, because it's a fascinating topic. And I'm considering doing another degree in law in terms of international trust, just to compare all of them, because so things are changing in South Africa. So I think we getting exposure offshore is crucially important. And there's quite a lot of interesting things happening as far as that's concerned. But I will keep you abreast of those developments as they happen. But it's early days at this stage. But international trust is quite an interesting topic. And I'm so glad to be a South African, because in South Africa things are a lot easier. So as far as that is concerned. Yeah, so just to get back to the presentation, I always tell people that wealth is the fruit, but what is the seed that you're sowing? People just think wealth is magically going to appear one day, and then they're going to live happily ever after. It's not so. Because what I know is that you need to sow the right seeds today to get the right fruits tomorrow.
Right.
And, you know, I've had the privilege of really meeting some very influential people and very wealthy people. And what I've learned from them is that to them, wealth is a multiple generational concept. So the wealth that you build today is a foothold you give your children, and then they can continue with building that wealth. So the more generations you have building the wealth, the more solid that wealth would be. So, and to me, that is the most important reason why to look at wealth differently. You mustn't just have a short-term view, you must have a longer-term view that you will be able to provide for your grandchildren eventually by learning or teaching them the principles that you are applying today in terms of your wealth creation. So yes, it's good to have the property as an asset class, but that's not the only thing. There's a lot more to wealth creation than just involving property. Because I promise you, I've seen very, very wealthy clients that accumulate a property portfolio of millions, but in their own name. So the problem with that is if they get divorced or if they die eventually, that there is going to be a loss of that portfolio of up to 30 to 40% just because of ignorance. So that's why I strongly promote the message of proactive estate planning. So I see that people often get so busy with transactions, chasing the next deal, but they forget about the bigger plan. Have a plan and work the plan. So, and that is to accumulate capital assets in your portfolio. The stronger your capital asset base is, the stronger your wealth. And it's not just about collecting rental income, it's also about the increase in value of that particular property as well. To give you an idea, I had clients in Garankuwa who had a shopping center, a beautiful shopping center, but they only had, if I can be straightforward, they had like Chinese tenants with only short-term contracts. And I said to them, look, this is the value of your shopping center, but if we take some of the short-term tenants out and we bring in brands, you'll have long-term contracts, and just having the signed long-term contracts will increase the capital asset value of the property itself. So we brought in OBC Chicken, MTN, and bakeries, etc., with branded names. So just by doing that, increase the value, the capital value of the whole shopping center. So that's why I say you have to look at wealth holistically, and not just look at the small little detail. You have to look at wealth holistically. So if you go to the next slide. So what I tell people is that your business is not what you do between 9 and 5 every day, but what you do with what you earn. That is the real business. For example, I see, a client that's a surgeon. So he works like 15 hours a day and he thinks that's his business. But at the end of the month, he gets quite a large sum of money. And that is the real business. What do you do with the money that you get at the end of the month? So, for example, in the surgeon's case is, yes, I've earned this money, but now my real business is to convert this income into capital assets and not spend the whole amount. So if you are left with 100,000 Rand a month, what do you do to convert that income into capital assets? That's your real business. So I often see that people look at their budget and that there's amount of X amount left over at the end of the month, and they see that as lifestyle. That is not the time to spend money on lifestyle. You should fund your lifestyle from your capital assets. So you should really have a long-term view in terms of wealth creation. It's not just about living from month to month. You have to really commit to make your financial position a formal business. So it's a bit of a reality check, but sorry, I didn't make the rules. That is the strategy that you need to follow. You need to convert income into assets during your economically active years.
Okay.
Okay, so let us look at the reasons why people often have a trust. And if any one of these reasons appeal to you, then a trust would be a worthwhile entity to consider. At the end, I think it's slides 13 or 12 and 13, there's a summary of how the structure gets put together. So if you don't follow now, don't to be concerned about it. We'll have a proper visual at the end of the presentation as well. Yeah, the first useful reason to have a trust is that you want to provide for your children and your grandchildren. So to give you a practical example, I've seen this quite regularly at the Master of the High Court. If your will reads that upon your demise, everything goes to the surviving spouse, and from the surviving spouse, it goes to your children. By the time your estate goes to your children, you've wasted between 30 and 40% of the wealth that you've accumulated in your lifetime. So that's, you work so many years to accumulate X amount of money, but just because of ignorance, you're going to lose 30 to 40% of that. Now, why is that important? Number one is that if the next generation had 30 or 40% more to work with, can you imagine what the impact would be of that wealth creation in the third and fourth generation? So instead of losing 3 million rand due to estate duty, capital gains tax on death, and double executors fees, your heirs could have used that money to invest in property for the next 20, 30, 40 years. So that's why it makes a huge, huge difference to have a multi-generational view on wealth creation. And the next point could be that, when you are involved with business, there is always risk involved. So you want to protect your assets against possible claims by creditors. Like, for example, during a holiday, there was somebody who took the refuse to a public refuge area owned by the estate where we were living, and the person slipped and fell and broke a leg. And there's a public liability issue there. So so life happens to all of us. Can you imagine that if you own a shopping center and there's a public liability claim against you and your assets were not protected in a trust, then the creditors could have laid claim to that particular property. But even your personal creditors, doesn't have to be just public liability, it can be any creditors. And then another fact of life is, unfortunately, people sometimes get divorced. Now, if you structure your trust in a correct way, then the assets you have in trust would not be part of a divorce settlement. But that's a topic that we can have another discussion on. But I'll talk about it in another slide as well. And then, of course, people say, no, I don't want to trust. I'll gladly pay the 2 million rand and of estate duty, etc. But that's money you're paying to the state versus 2 million rand could have gone to your children. So you can choose whether you want to pay the money to the state, which you've got no control over, or you can pay the money to, or your beneficiaries would have 2 million rand more to invest. So that's completely up to you. But why work so hard to accumulate wealth and then just because of ignorance lose that wealth again? It just doesn't make any sense to me whatsoever. And then the other case, which I've, you must remember, I've got 23 years of experience in this topic. I can give you practical examples of the next particular case. So say, for example, your life cover contract was in your private trust and you develop Parkinson's disease, for example. In other words, you are mentally not capable of dealing with your personal affairs. Then that insured amount will pay out in your trust bank account and your co-trustees will assume the position of a curator. So there's a seamless transition between your incapacity and your family being provided for, including yourself. The alternative is, if you can't manage your affairs anymore and you don't have a trust, that a curator would have to be appointed on your behalf to manage your affairs. Now, that is a really big nightmare. I've seen at the Master of the High Court, because a curator is somebody who's risk averse. They don't want to take any chances with your money. So when your family needs money, they would have to approach the Master of the High Court and get permission for that expense, whatever that might be. And that can take months. And then often they say no, because we want to preserve the capital. But when your life cover was paid out in, or the disability cover was paid out in your trust, your co-trustees knows what is the best for your particular family. It's not a legal person far off. These are your co-trustees, so that they know exactly what your circumstances are, and they are in the best position to deal with your family's needs. So those are the majority of reasons why people use a trust in their financial planning, and it can be either one of them. It doesn't have to be all of them. So there's a lot more than just tax planning. There's a lot of personal aspects that should be taken into consideration as well. Okay, so just to give you some legal technical information as well, because people say they have a trust, and then you ask them, but what kind of trust is this? And they've got no idea. So the trust that we use in financial planning is called a discretionary trust, and it's inter vivos. That means it's set up during your lifetime, versus a testamentary trust, which is only set up in your will, and set up, in other words, after your demise. Now, you can't use a testamentary trust for financial planning because it doesn't exist yet. It's only set up after your demise. So the ideal trust to use for financial planning is a trust that's set up during your lifetime. Now, we get two types of trust that can be regarded as inter vivos trust. That's called a discretionary trust and also a vesting trust. Now, a vesting trust is a situation whereby you've got a child that is, for example, disabled. So you set up a special trust for this person. So you transfer an amount of money into this trust while you're still alive, but that is called a vesting trust. So that child is actually the owner of that trust assets, but that child cannot manage that assets. So that's why it's placed in a trust, so that somebody else can take care of that child's needs. So that's called a vesting trust. But the trust that we use for financial planning is called a discretionary trust. So I'm going to show you what that basically means. So with a discretionary trust, the trust is the owner of the assets. So that means the trustees decide what to do with those assets. And when they want to give a benefit to one of the beneficiaries, they can decide at that particular stage in time in future, in the prevailing circumstances, what they want to give and how much they want to give and to whom they want to give that. So under no circumstances can a beneficiary come to the trustees and say, look, I'm a beneficiary of this trust. I now want X amount of capital from this trust. That beneficiary has got no vested interest in the trust assets before the trustees is actually giving him a distribution. Now, why is that important? Because I've also seen a lot of things in the financial planning environment is that the parents started the trust 20 years ago and they've accumulated some assets in the trust. And now a child comes and says, but I'm a beneficiary of the trust, I want money. Unfortunately, that beneficiary will not have an entitlement to any trust assets unless the trustees have exercised their discretion and pay an amount over to the particular beneficiary. The other advantage of that is that you accumulate a lot of money, your children are spendthrift or they marry in community of property and they get divorced, and that divorced spouse claims some of the trust assets. So in this particular case, when you use a discretionary trust, what happens to your children has got no bearing on the trust assets itself. So that is why we use a discretionary trust. So it means that in future, in the prevailing circumstances, the trustees can decide what they want to give the beneficiary, when they want to give it to the beneficiary, and what exact amount is it they want to give to the beneficiary or to which beneficiary they want to give it. So that is in their complete discretion. So it remains a trust asset under protection for as long as the trustees do not exercise their discretion. Another option is that the trustees can have a smaller trust within the original trust, is that they want to give a particular child X amount of money, but they want to put that in a separate trust for that particular child. So the trustees still administer that assets, but a particular beneficiary will be the sole beneficiary of that amount eventually. So you can have a trust within a trust, which is actually a very interesting phenomena within the estate planning environment. Okay, what can you not do with a trust? This is very, very important because when we deal with trust, it's not the same as a company. when you deal with a company, you get a certificate of incorporation, which states that this is a particular company. Now, I've seen plenty of court cases whereby there was a trust. Now the guy gets divorced, and the spouse then says, but this was never a trust because he was the only person that ever acted within the trust. So, and then they apply the principle of substance over form, and they say, sorry, that even though you got a letter of appointment, this was not really a trust. So when they look at a trust, they look at your paper trail. So every transaction that you enter into, and this is incredibly important, and if you forget anything about this presentation, this is one thing that you need to remember, is that you need to keep a paper trail of all trust transactions. Now, normally I draft the resolutions for all my clients, so you don't have to worry about the legal compliance of that resolutions, because I do it. I've been doing it for 23 years, so I know exactly how it works. So say, for example, you see this property, you go out and you buy it on behalf of the trust. There was no resolution by your co-trustees authorizing you to buy that particular property. So say, for example, it accumulated in value by R1 million, you get divorced. Because there's no resolution stipulating that it was a joint decision by all the trustees, that transaction will be regarded as part of the alter ego of your private estate. So that is why it's very, very important that when you deal with a trust, you must always involve your co-trustees in that particular transaction. So if you put a resolution that states that you've got 3 trustees and trustees 2 and 3 agree with you on the transaction, then you are perfectly fine. But you should never act unilaterally. The moment you act unilaterally, that transaction will be regarded as an alter ego of your private estate. So, and obviously that will be subject to your creditors and divorce and deceased estate, etc. So you should never act unilaterally because it's not your assets. So the legal argument is that if you can act unilaterally, then it must have been your asset. But if you act jointly, then it must have been a trust asset. So that is a legal distinction that's very, very important. And one other thing that I've seen quite often, which is really crazy, fortunately we stopped it in most cases, is where somebody drafted a will and they stipulated, in my trust are the following assets. I bequeath these trust assets to my children in equal shares. You cannot do that because it's not your assets to bequeath. So the moment you act unilaterally, because a will is a unilateral legal contract, so the moment you do that, the SARS would say, but this was not a trust. If you can bequeath those assets in your will, then it wasn't the trust asset, it was your personal assets. So how we normally deal with something like that is the trust can also draft a resolution stating that in case of the demise of trustee A, we as trustees will distribute the trust assets under that particular circumstances as follows. And then the trustees will sign that resolution, and it's got the same legal force as a will, but it's not regarded as a unilateral transaction. So that you have to have a clear distinction on how to do that. So you can never bequeath trust assets in your private estate. Is that clear, TJ? Do you want to ask me something about that?
100%. I think you've just touched on the do's and the don'ts there. That gives us a clear guidelines of how to play in the field.
Yeah, absolutely. So it's a simple thing. So you must remember that you can't act unilaterally, and you must always have a paper trail. If you only remember those 2 rules, then your trust will be a pleasure to deal with. So it's only those 2 things. You can't act unilaterally, and there should be a paper trail in terms of every transaction. Okay, so what can you do with the trust? This is the real interesting part. So in South Africa, trust is not regarded as a separate legal persona. It's a bit of a quasi legal situation. But to answer that question, the easiest thing to explain is that you can do anything with a trust that you can do in your own name, except for 2 things. You cannot have a retirement product in a trust, for example, like a retirement annuity, because a trust can never retire. A trust is not a natural person that can get to age 65 and then retire and get a payout. So you can't take a retirement annuity contract in your trust, or a preservation fund, or a provident fund. So that's a financial product. You cannot have it in a trust, and you can also not have for example, a PPS, income replacement contract, in a trust, because a trust is not a natural person that can work physical hours. So apart from those two things, a trust can buy property, a trust can sell property, a trust can rent property, it can acquire services. So there's no limitation on the type of transactions that any trust can do. You can do exactly the same things you do in your own estate, you can do in a trust, apart from a retirement annuity product or retirement products, and also income replacement product. So those are the only things you cannot do with a trust. But apart from that, you can do anything. You can run a business, you can buy, sell, you can bond, you can apply for loans. Every possible transaction you can do in your own name, you can do in a trust as well. Okay, so who can be trustees of a trust? That's actually quite interesting, because I see a lot of people that's got resident status in South Africa, but they're not South African citizens yet. So they only got a passport. But as long as you've got a South African trustee in a trust, even people with a passport can have a South African trust. So that's actually quite useful. And you must be 18 years of age, and you must not be sequestrated, and you must not be mentally unfit. So if you don't find yourself in any one of those situations, then anybody can be a trustee of a South African trust, provided that you have an independent person as another trustee. So that's not part of the Trust Act, but it's a requirement from the Master of the High Court, because they was involved in so many transactions with trust where there's a mediation going on. And they said, now from now on, there should be one professional person in a trust for them to be able to register that particular trust. So apart from that, anybody can basically be a trustee of a trust. Now, this is this slide where things can get a bit of hectic. So this is just a suggestion. Teacher, just one thing that I want to make clear, there's no one vanilla flavor in terms of a setup. So this is a suggested scenario, but normally when somebody acquires an asset, then we look at where to fit it into the structure. So it's not a hard and fast rule. So it doesn't mean that all your buy-to-lets goes into a property trust, or your speculation properties goes into a property company. Every transaction will require you to make that decision in terms of which entity that a property would go. So this is basically my suggestion. So normally a person would have two trusts. One is called, the one in gold is a private trust, and the one in red is the property trust. Now, the reason why we split that is to ring fence your risks, because your financed assets will go into the property trust, and your cash assets will go into the private trust. Why is that advisable? So say, for example, something terrible happens and your whole property portfolio is going to be sequestrated, it's worth nothing. Then all the assets, the cash you've accumulated in the private trust will be protected. So if your cash was in the same trust as the property portfolio exposed to debt, if that trust is sequestrated, then you would also lose all your cash assets. And that's the worst position that we want to be in. Now, fundamentally, what I want people to understand with this slide, the most important entity in this whole setup is your private trust, because that is the trust that's going to provide you with the cash to fund your lifestyle. Because when we invest in property or we start a business, it's not that it's that we accumulate a whole portfolio. We have these things so that these things can give us cash from which we fund our lifestyle. I always use the example, if somebody goes to Woolworths with a whole big trolley full of food and you get to the till and you have to pay, they say, oh, but I've got 10 properties. Give me the food. They're going to laugh at you. They say, but you have to pay cash. You can have all the properties in the world, but unless you've got cash, then you can't fund your lifestyle. So the reason why we use property as an asset in financial planning is because these assets will eventually give us cash, be it from a sale of a property, being it a surplus income. That income has to go somewhere. And normally that ends up in the private trust in investments. I'll talk in the next slide more about that as well. So the most important entity here is the private trust, because that's cash. Cash is king. Cash will give you a lifestyle, so you need to protect your cash. So you'll see the green circle is for a property company. So a trust is not an ideal vehicle to speculate in. A property trust is ideal when you buy a property. And I've got a client in the East Rand who is brilliant at student accommodation. So you're never going to speculate with student accommodation. You buy the property and you let it out indefinitely for years. So that type of property is ideal for a property trust. So what happens is you buy the property in the property trust, and the trust collects the rental income on a monthly basis. Now, what happens is that as the rental, and this is a technical, so please bear with me. So as the rental income accumulates, most likely the capital value of the property will also increase, because your long-term rental income determines the capital value of the property itself. So what happens is that after a number of years, depending on your rental income, you can refinance that particular property. So when you refinance the property, your capital bond goes up again, and the difference between the old bond and the new bond is your capital growth. Then normally people take out that capital growth and they put that into the private trust. So at least that capital is safe in the private trust. So now your increased rental income will pay the increased bond. So we call that neutral gearing. And also, this is just a strategy. You don't have to follow it if you want to, but you must remember that the whole purpose of this business is to get capital. So it's not just to accumulate 20, 30 properties. You need capital. So that's why we look at the neutral financing model as well. So you can use that capital that you've distributed to your private trust. You can now use some of that capital as a deposit on another long-term buy to keep property. So whatever you do with that capital, yes.
The question that I actually wanted to ask you here, Thomas, was actually around, so if I've got my first property that I've bought in my property trust, and now when I've finished paying it, do I then take that property out of my property trust into my private trust? And I'm glad you have just given me another scenario there where I can refinance it. Now, when the debt is there, but the capital is available to me now, I now need to go. So I'm running away from capital gains in that trust. But the capital, I can go now and buy a 2-bed, 1-bath somewhere else, but it's cash. And it sits in my private trust.
So the cash is now, the cash you invest in your private trust, but so if you buy more property, then you buy that in the property trust again, but you use some of the cash in the private trust as a deposit on the property in the buy to let. So, so why is that important? I'm so glad you mentioned that. You must remember, I always tell people that the more cylinders you've got in your engine, the stronger your wealth engine will work for you. If you've only got one property that's paid off, that to me personally doesn't make a lot of sense, because if you buy a property worth R1 million that's paid off at R1 million, you're only going to grow on R1 million. You're not going to grow on R2 million just because the property is paid off. But say, for example, you take that R1 million out and you put that down as 200,000 Rand deposits on 5 more properties, then you've got 6 cylinders in your engine. So can you see how your wealth engine will then start growing, will actually grow better? So, because if you've got one property that's paid off, you're going to pay a lot more income tax on that one property, because there's no deductions against that rental income. The interest portion on your bonds are tax deductible. So why, let's say, for example, you've got a property that's worth R1 million that's paid off, and you get 10,000 Rand a month rental income, you're going to pay 4,000 Rand a month of that in income tax, because there's no deduction against the interest portion. So I would rather not pay off the property, but rather use that equity in the property to put down on more cylinders. So that the more cylinders you have in your engine, the better this engine will run for you. So does that make sense?
100%.
Yeah. So so I would rather have more cylinders in the engine that will just strengthen your wealth creation engine. So and obviously when the money lies, so let's say, for example, you've got a property with R1 million and you've refinanced and you got 500,000 Rand out of that property. So the 500,000 rand will go to the private trust, and then the trustee is going to decide, okay, we're going to use this 500,000 rand and make a loan to the company of 100,000 rand to buy speculation property, but we're going to invest 200,000 rand in an investment in the private trust. Let's, for example, at Alan Gray. I love Alan Gray as an asset manager. I would put my money nowhere else but with Alan Gray. And then you're going to use, so now we've got 200,000 rand left. So we're going to use 200,000 rand to put down as deposits on 2 more properties. So that's what we do with the cash that we've raised. So you must remember that one thing that I saw as a CEO of a property company is that people, they've got a huge property portfolio, but they've got very little cash reserves. Now, why is that a risk? Because you must remember, property is a brilliant asset class, but it needs maintenance. And what happens if the tenant can't pay the bond? What do you do then? So then you are at risk. You put your business at risk. So when you look at property in terms of a solution, in terms of wealth creation, TJ, it's very important that you look at your cash reserves as well. I normally recommend that you would have 20% cash to the value of your whole property portfolio. So we invest the 20% cash at Alan Gray, so you still get growth on that 20%. And what happens is that, say for example, your R1 million investment with Alan Gray is now grown to 1.2 million rand. Then we take the 200,000 rand on the investment growth on the Alan Gray investment, and we put that down as a deposit on more property investment. So the strategy works both ways. That the growth you get on your cash at, for example, Alan Gray, you can eventually use that growth as a deposit on another investment property. So, but it's very, very important that we manage the ratio between your cash reserves and the value of a property portfolio. Because you need to do maintenance, you need to pay the bond if the tenant is not in a position to pay. And these are realities. These things happen. So we've seen at the property company where I was a CEO, it was blocks of flats in Sunnyside, and the rental income was fantastic. But the guy used all of that income to fund his lifestyle, and there was no money going into the maintenance account. So guess what happens to that building 5 years down the line? It's a dump. Nobody wants to live there because there was no maintenance for 5 years on that building. Yeah. So you must remember, you have to respect your tenants. They are your clients. If you give them a crappy environment to live in, they're not going to be loyal to you. They won't want to move out, and then you sit with vacancies. So it's very, very important that you respect your client and maintain the property to the best possible standards. And people use something like Wi-Fi as an additional benefit for your tenants. It's very important that you respect your tenant as a client. If you don't respect your client, you're not a proper businessman. I'm sorry. So it's very crucially important that it's crucially important that you respect your tenants as clients as well. And then, of course, when you want to buy a property for speculation purposes, say for example you buy a fixer-upper, and you can buy it on an auction for R1 million. You know, you're going to spend 200,000 rand to get this property in tip-top shape again, but you can sell it for 2 million rand. So when it's a buy and sell type of property, we buy that in a property company and not in a trust. So you never buy and sell properties in a trust because of the tax rate. You can see that your effective capital tax rate on buy and sells of property in a property trust will be 36%, while the effective CGT rate in a company is only 22%. So that's why we buy and sell properties in a property company and not in a trust. So, let's say, for example, in a worst case scenario that you bought this property in a property trust, and initially it was a buy and sell, and eventually you realize that this was not the best buy and sell property to have. Then you can still sell that property from the trust, but the capital gains you distribute between the capital beneficiaries of the trust, in which case the trust will not be liable for the capital gains tax, but each individual capital beneficiary of the trust. And most people have a large capital annual exclusion, so then you won't pay any capital gains tax on that individual transaction as well. But that happens by exception, that when you buy a property that 5 years later you realize this is not the best possible property, and then you sell it. Then you can distribute the gains to the beneficiaries. So the rule with the trust is the tax is paid where the amount is vested. So if the trust keeps the gains, then the trust will pay the tax. But if they distribute that gains to the beneficiaries, then the beneficiaries will be liable for that capital gains, but subject to the annual exclusions. So
Right.
big advantage, believe you me, when I started the Viewers Trust division of Old Mutual in 2000, it was in the exact same year the capital gains tax was introduced. And everybody said, no, that's the end of trust, capital gains tax, it's not worth it anymore. But then we actually had a look at the act and the application of trust, and then we realized that the trust doesn't automatically have to pay the tax. It's only if the trust pays the tax that there's a less beneficial scenario, but the trust can distribute the gains to all the capital beneficiaries. So let's compare that with the scenario of having a property in your own name. So say, for example, you've got a property portfolio in your own name, and now you decide that you want to dispose of this one particular property, and your gains is, say, for example, 500,000 Rand. Then you don't have the discretion to distribute that gains to beneficiaries, and you will personally be liable for that capital gains tax. But if you can distribute that gains to 4 or 5 capital beneficiaries, which will normally be your children, so each one of them will then get a capital gains tax exclusion. So that's a huge, huge benefit. But that's the exception on the rule. But normally you buy to let long-term key properties in the property trust. So now if you look at the property company, so when you establish a property company, it's very important that the shares of that company will be in your private trust from the very beginning. Because once that property trust, the property company has a cumulative value already, it's going to be a bit of a legal challenge to sell the shares from who owns the shares at that particular stage to the private trust. So normally we tell people to set up your private trust first, and then the private trust will be the 100% shareholder of that property company from the very beginning. So there's no risk later on of transferring shares from one person to a next person. So immediately when the property company is set up, the private trust is already from the very beginning the 100% shareholder of all the shares in that particular company. So, so if you look at the scenario with the property company, so when you sell a property, a speculation property, a percentage of that capital can be distributed to the private trust, which will be subject to a 20% dividend tax on the distribution. But that's only if they make a distribution. If there's no distribution to the shareholder and they want to use all of that capital to speculate with it again, that's perfectly fine. There will be no dividends tax payable on that particular transaction. Obviously, there will be income tax implications as far as that is concerned. Yeah, and most importantly is that you as a beneficiary, TJ, you and your wife and your children are beneficiaries of the private trust. So what basically happens is that of the capital that's accumulated in the private trust, the trust will eventually, at a particular stage in the future, make a distribution, a capital distribution to you and your family. That distributions to the beneficiaries is completely tax-free. So you'll not pay any tax on that capital distributions going to the beneficiaries eventually. That might, and there's no limitation on what the trustees can apply the capital for. It can be for your kids' education. It can be to buy a car for them, whatever the case might be. So there's no limitation on what the trustees can use the capital of the trust for. So yeah, so I think that's quite a busy slide. Do you have any questions regarding that?
It's quite clear to me. Thanks, Thomas, on this. It
Okay.
looks, yeah.
Fantastic. Now, if you just look at the next slide, so if you look at your business model, what goes where? So in your private trust is your cash assets. For example, your bank account, with your money market account, or whatever the case might be, your life cover contract, and also your other investments. Now, why is it important to have your life cover contract in your private trust? I hope you don't hear the neighbor cutting down the tree. Are you good? Okay, because it's driving me nuts in the background. But in any case, so why is it important to have your life cover in the private trust? You must remember that if the trust owns the contract on your life, the moment you pass away, the trust didn't pass away. So the life cover proceeds can pay out in your private trust bank account immediately. So there's no waiting for the letter of appointment of the executor that can claim that amount of money. So the money will pay out in your private trust bank account immediately. and they can even pay for your funeral or whatever the case might be. And the same goes with your disability cover. So if you become disabled, the proceeds will be paid out in your private trust, and your co-trustees can decide what to do with that capital. They can even use some of that cover amount to buy more properties with that. So it's not a transfer from an estate into the trust and then from there to the other entities. The life cover amount will pay out in the trust bank account immediately. So yeah, and then obviously your other investments, like, yes.
So this is pretty new what we're talking about here, Thomas,
Yes.
for me, right?
Yes.
And so you saying that once I have a private trust,
Yes.
the trust can take a life cover on me, however,
Yes.
in its favor.
Yes. Yeah.
So that also goes with disability. So, but I don't need to take it.
Yeah. Yeah. So the trustees will apply for the contract with whatever particular company, and the trust will own the contract, and the trust will be the beneficiary. So how the trust pays for the contract is that, remember, you've got annually 100,000 rand that you can donate to the trust. So
Yes.
you will donate the premiums to the trust on a monthly basis. So that's where the trust gets the money to pay for the contract on your particular life.
Right, right. But
Yeah.
obviously now this is very difficult if, and I think this is where sometimes, the complication of being an entrepreneur and an employee.
Yes.
Because as an employee, your employer might give you or pay for your life cover, but now you can introduce your private trust. You can't do that.
Yeah. Yeah.
But as an entrepreneur, you can dictate that. You can do that on your personal capacity, dictate what's happening in your private trust.
Yeah.
Okay.
Yeah.
Good.
Yeah. But the thing is, from experience, I know that most people, that their group life cover that's paid by their employer is normally not enough to fund their needs. So most people have got an extra life cover in their own name, but that's the type of cover that should rather be owned by your trust as opposed to the individual. So your group life cover, that's unfortunately there's nothing we can do about that. That's unfortunately just the way it is. But the shortfall on that group life cover, that cover you take out in your trust. So you are the life assured, your wife is a life assured, and so you and your wife can be the co-life assured on one contract within the private trust. So if either one of you would pass away, the life cover amount would pay out in your private trust. So yeah, okay. So obviously in your private trust, that is your finance growth assets. So the debt is in the red one, the cash is in the golden one. So all the debt assets that you need to finance goes into the property trust. It doesn't just have to be a physical bricks and mortar type of assets, any asset that you can finance. Interestingly enough, people always ask me, but what do I do with my car? Should I buy the car in my property trust or in my own name? There's actually a very simple answer to that. Assets that you'll see there, it says financed growth assets. So that's why you keep that financed growth asset in the trust and not a financed asset that depreciates in value. For example, furniture and cars depreciate in value. So say, for example, you buy a car in the trust, there's a loan account of, let's say, R1,000,000, but every year that car reduces in value. So that means that trust is factually insolvent because the underlying asset is worth less than the debt. So that's why we won't put finance assets that depreciates in value in the property trust. So if you want to buy an asset that depreciates in value, you buy that in your own personal estate. So does that make sense?
Yeah, makes sense. Thank you.
Okay. Okay. So in the property company, then you got your speculation properties, a property that you want to fix up, or you buy it to sell it eventually. So it's not something that you want to keep long term. You know that, and most people when and I often challenge people on this point, that when you buy a property, you have to know what you want to do with this property. And sometimes I find that people buy a property because they like the kitchen or they like the bathroom. And unfortunately, that's not an investment. So an investment is something what happens to your cash flow of this property over the long term. Whether the kitchen is nice or not is actually irrelevant in terms of it's got a it is not irrelevant in general, but it's not the reason why you buy a property. A kitchen is nice because the tenant might like that particular kitchen or the bathroom. So that is so that's the relevance of a bathroom. But normally, so I challenge people normally if they buy a property, I ask them, what do you want to do with this property? Is this a buy to let or is this a buy to sell? So because that is important because you know what entity to put that property into. So because you can't buy to sells in your property trust because it's not the right entity for that particular asset. So that's why I challenge people and ask them, what is your long-term goal with this particular property? Does that make sense?
Yeah.
Am I just being particular? Does it make sense?
No, you make sense.
Okay, 100%. Yeah. So if you remember this slide and the previous slide, then that's basically the essence of the whole strategy. So obviously, I think that's basically those are my details. But people always ask me what the main advantage of a trust is the long-term costs. So normally, when I am a co-trustee in a trust, I don't charge a person a monthly trustee's fee. But when there is a particular transaction, then I charge you for that paper trail because it's to your advantage and to my advantage. Is that because when you enter into a transaction, you don't necessarily have the background to draft a resolution. So when you enter into a transaction, I've got the legal expertise how to do that, and then I only charge you a fee for that particular transaction. So if there's no transaction in that particular year, there's no fee. So I know most of the fiduciary.
You're a pay as you go guy.
Yeah, exactly. Yeah, it's just that from an ethical point of view, I cannot see why I should charge a client just because I'm appointed as a trustee in that trust. If they've done nothing, why should I get paid? So when I draft a resolution, that is something that I'm doing, and it's ethical then to charge a fee for that particular transaction. So if somebody does quite a number of transactions, then they're going to pay for every transaction. But if they don't, if they do one transaction a year, then there's no fee. And I can also just mention it's not a legal requirement to have an auditor appointed. So it's not a legal requirement, but I would advise to do the books of the trust annually, because especially in the property trust, because if you're going to be buying properties, then the bank's going to ask the financial statements of the trust. Yes. So, but the private trust, there's no reason why the private trust should have any books, because it's only cash transactions. The private trust is never going to enter into a transaction whereby they want to apply for credit, because we never have credit in the private trust. All credit is placed in the property trust. Right. So there's a lot of ignorance out there that people say, but you have to appoint an auditor. No, you don't have to. So it's not a legal requirement, but it's useful if the property trust is going to enter into transaction and have financial statements, and also to be able to complete your income tax returns for the property trust. So
awesome.
Yeah, so there's no legal requirement as far as that is concerned. Yeah. So TJ, that's basically my introduction. So you can go back to the slides and look at that and email me with any queries that you might have. Or is there any specific queries that you might have at this stage?
I think this is quite a mouthful for anyone who's watching this. Thank you very much, Thomas, in terms of putting this together for us. And my view is that, well, firstly, I have actually some personal actions that I need to take with what you have actually shown us today. I've actually looked into, whilst you're presenting, I looked into myself and I said, where are my gaps? And I identified what the gaps. And now my role is obviously to engage with you on my personal gaps. And for anyone who you are seeing the gaps, or maybe you have never even done a trust, well, this is for you. So thank you very much, Thomas, for this.
Absolute pleasure.
And we'll check you again on the next video.
100%. Thank you so much.
Thank you.